Hello, my name is Valentin Khokhlov, and this is a next upcoming meeting of our investment club where we discuss different matters related to the stock market, to portfolio management and investments in general. And this fourth issue is dedicated to contrarian strategies and indicators, and this topic appears because last October I reviewed the Ukrainian translation of a book called Financial Market History. This one, let me show you. And a chapter from this book called A Historical Perspective on Time Varying Expected Returns, written by Antti Ilmanen, who is a director at AQR Capital Management. It's quite interesting in my opinion, and by the way, this is a Ukrainian translation of this book, for which I was a reviewer for the first section, including this chapter. And this topic seems quite interesting, and it relates to investment strategies, indicators, predictors, and quite interesting results. So let's start with how the investment managers can create value basically to their clients. The first source of value is stock picking. The legal way is to conduct comprehensive financial analysis and select stocks that has a good perspectives of increasing in value. And of course there's illegal way of doing things. It's called insider trading. If you know something that other people don't know, and you can buy or sell securities based on this insider knowledge, it's a good way to pick assets, but it's illegal and unethical. So I definitely against doing insider trading. We don't discuss that in our investment club. The second source is market timing, which relates to choosing the right time to enter or exit an investment. And the legal way to do this thing, again, is to conduct a comprehensive financial or macroeconomic analysis and make decisions based on right signals that tell you what is the right thing to do, to enter or exit some assets or asset classes. And again, you can do this illegally using insider trading if you possess some information on what the government is going to do, what are the key players to introduce to the market, or some agreements between like OPEC cartel or other countries that might affect oil prices, and you know it before the market. You can get some benefit from that, but it's illegal and unethical. So you can do that, but I'm against such unethical and illegal insider trading schemes. So the next value source is asset allocation, and of course you can choose the right structure of your portfolio or your client portfolio and create value this way, and you can make use of optimization models or other models of portfolio composition, and if you do good job, you can conduct superior allocation adding value. And fourth source is to increase value of already acquired assets. This is what most private equity firms do, and venture capitalists also do this by actively engaging into the management of the companies they acquire, optimizing their business models or cost structure, or finding new revenue streams, or reducing cost of capital. If you can get capital from sources that were not available to the acquired companies before, and you can get cheaper capital or raise funds that their companies had been unable to raise, and you can get some additional value by your knowledge or skills, and of course the result is an increased valuation multiple. So you enter a transaction at 3 EBITDA and you exit at 6 EBITDA. So you get much value just by doing the things right and increasing value of the assets. So everything is possible, but now we'll talk about second and third options, about market timing and asset allocation, and mostly about market timing. And here the key thing is to forecast the expected return. And there are several approaches to that, as Antti Ilmanen considers in historical perspective. The simplest one is to assume a constant expected return. For example, you can take the long-term geometric mean over like 115 years. It equals to 5% per year. It's what the equity return was. Of course, nobody guarantees you that the future return will be the same as the past return, and even in a considerable on a considerable time horizon, like next 5 year, next 10 year, nobody can predict, and even to assume it's constant is quite naive, but it's the easiest way, and it can be an anchor to start with. But then the things became more sophisticated, and scientific theories appeared in the end of 60s and in 70s. Different theories based on rational behavior of investors were developed, and they assumed time varying volatility and time varying risk aversion. And valuation models were developed based on that. For example, discounted cash flows, discounted dividends, and other models. And the important feature of this approach is the assumption of mean reversion, and that means that if you have an asset which is overpriced, it's unlikely it will increase in price, so the expected return is low, and vice versa. If you have an asset that is underpriced, that has some intrinsic value which is way above its current price, there's a good chance that the price will revert to this intrinsic value, and the price of course will increase, and the expected returns is therefore above average. So that's called mean reversion. Underpriced assets should increase, and overpriced assets should decrease, or at least have a low expected return. But at the end of 70s and beginning of 80s, different perspective appeared based on behavioral finance, based on irrational expectations. They assumed time varying investor sentiment. They were based on psychology, and many psychologists entered this financial sphere to develop based on like psychological view and on such phenomena as greed and fear. and that also has its niche. And finally, those theories were based on valuation signals. But there is second stream or second group of signals called momentum or trend signals, and they use past performance in recent months as a predictor of future performance in the upcoming month. But we will consider two models based on rational expectations, as Antti Ilmanen considers them in this chapter, which I'm speaking of. And the first model is based on Shiller's EP ratio. Most of you, I think, know Shiller's PE ratio, which is price to earnings. High price to earnings means the asset is overpriced, so you get the same earnings at the higher price, which means the asset is overpriced, and low PE ratio means contrary, asset is underpriced, so basically it's cheap. And the inverse ratio called earnings to price or EP ratio, and the meaning is opposite. Low EP means asset is overpriced, and high EP means asset is underpriced, and therefore high EP implies high expected return and low EP implies low expected return, which is the concept of mean reversion. Overpriced asset have low price growth potential already at high price, so nothing to increase, and therefore expected return is low. And underpriced assets have high potential for growth and therefore high expected return. And the corresponding investment strategy would be to invest into high EP assets and avoid or short sell low EP assets. And the corresponding market timing strategy is to consider the EP of the market, and if the EP of the market is high, it means the market is underpriced and you should enter it, or you should overweight equities and have a weight above 100%, and vice versa. With low EP ratio of the market, you should avoid investing into equities, exit equities, enter cash, and so on. And the DDM, discounted dividend model, is based on well-known and quite naive way of valuing companies, to take expected dividend and divide by the cost of capital less the growth rate. And from this formula we can derive the expected return, which is the same at the equilibrium as the required cost of capital, and it's a dividend yield, which is dividend divided by the price, plus growth rate. So two sources of the expected return is growth rate and dividend yield. And Antti Ilmanen had a simplification. He supposed that the growth rate, he assumed basically that the growth rate is 1.5%, which is an empirical estimation based on long-term growth rate over the last 115 years. And example for year 2014, the dividend yield for S&P 500 was 1.7%, and the expected return therefore was 3.2%, because it 1.7 plus 1.5 the expected growth rate. So basically as simple as that. And what we can draw from the analysis of two models. So here on this chart you see the next 10 years return in light blue line, which is based on S&P 500 market index for next 10 years, and dotted black line is adjusted Shiller's EP, which is basically EP with a small adjustment And the solid blue line, dark blue line, is a dividend yield plus 1.5%, which is like DDM model used by Antti Ilman. And here you see that in some years the EP model was quite close to the upcoming actual return in the 20s, here in the beginning of 30s. End of 70s and early 80s, but otherwise you see the huge discrepancies between the model and the actual return, especially in 40s, 50s and 90s and year 2000 and after the dot-com bubble, basically. So how to use the EP model on practice? Basically, you get the assets from your investment universe and you divide them into quintiles here. So you divide into groups based on their EP ratio. The assets with the lowest EP ratio, the first fifths of assets into this group, second fifths, third fifths, like medium range, and then higher EP ratio, fourth quintile, and the fifth quintile, the assets, 20% of the assets with the highest EP ratio. So basically you categorize the assets into those 5 groups. You can use 4 groups, 6 groups, 10 groups, whatever the amount you would like to choose. You just divide by EP ratio and you invest into the cheapest assets based on this ratio. So here the 5th quintile, maybe 4th quintile. So like right hand side is the assets to invest, and the left hand side, the like first quintile, second quintile, so the assets with the lowest EP ratio, which are most expensive, overpriced assets you tend to avoid or even short sell. So that's basically stock picking strategy based on this EP model, and later we'll consider market timing strategy based on this indicator. And this is essentially the contrarian strategy, because you go against the market, you go against the current trend on the market. And how you do it? The idea is simple. You buy stocks when they are underpriced, when the market is low, and you exit stocks and enter cash when the market is overpriced, when the market is like at the all-time high. So sounds quite simple and logical, but how to choose the right point of time when to enter, when to exit. So this suggested way of building a simple contrarian strategy would be you choose 2 asset classes, stocks and cash. Stocks could be S&P 500 represented proxied by ETF like SPY or another ETF, and the cash is just cash or T-bills. So when the EP ratio is high, your asset allocation to equity should be high, and vice versa. So you can do that based on quintiles, on the current quintile of market's EP ratio. If it's in the highest quintile, you basically allocate 150% into equities and short 50% in cash. If it's in the 4th quintile, you allocate 125% to equities, 3rd quintile 100% into equities, 2nd quintile 75% equities, 25% cash, and the 1st quintile, so market is overpriced, you put 50% into equities and 50% to cash. Basically, the EP calculation is based on the rolling 60 years sample. So you get sample of like past return, past 60 years of not returns but prices and earnings, and you calculate EP ratio and you see what's the current EP ratio compared to this sample. So basically you build this contrarian strategy. You need to compare that. The natural comparison would be the buy and hold strategy, which allocates 100% into stocks. So you buy S&P 500 index in year 1900, and you keep full allocation to stocks at all times. You don't change your portfolio. What would be the results? You see here on the upper chart that dotted black line is a contrarian strategy, and bold blue line, dark blue line, is a buy and hold strategy, all time invested into the stocks. And the light blue line below is the return differential, which is cumulative return, of course. So you see the cumulative returns of contrarian strategy is higher than cumulative returns of buy and hold strategy over this time horizon, but it reaches the highest point around year 1955 and then goes down. So basically starting from 1955, you would be better off if you invested into buy and hold strategy than invested into contrarian strategy, which is bad for contrarian strategy proponents, because basically the strategy failed to create value in the second half of 20th century. And if you consider the lower chart, which is the proposed weight on US equity, so allocation to stocks, you see that in 60s the allocation was 50%, and in 90s 50%, early 2000s it was 50%. The model suggested exiting equities. Why? Just because we saw it here, the model supposed the signal would be that the market will go down, and here that market will go down, but the market didn't go down actually. So basically the model was wrong about this allocation, and hence it failed to deliver superior returns. So what conclusions Antti Ilman makes of his analysis in this book? So first of all, the visual analysis. It looks good. EP seemed to be a good predictor of returns for quite a long period of time, from 1915 to 1940 and from 1965 to 1980. But the forecast from 1940 to 1965 and after 1920 was quite poor. So were good times for the model, were bad times from the model, and DDM model was worse than EP, so he didn't consider this model in his analysis from that point. But if we consider the correlation coefficient, it was mediocre. It was not zero, of course, but well, zero means no correlation, no statistical relation between the prediction and the reality. It was not zero, but it was not close to 1. It was 0.57 for the EP model and 0.42 for the DDM model, which is not very good basically. So not very strong correlation between the prediction and the reality, which is bad for the model. And if we compare the contrarian strategy with the buy and hold strategy, we see small extra return delivered by the contrarian strategy, but it was generated before year 1950. So basically the second half of the 12th century was a bad time for contrarian strategy, which is not promising for modern investors who cares little about what happened in the first half of 20th century. So why the contrarian strategy did not work good, they did not deliver good returns. So the model assumed in 60s and after 1990 that the market was overpriced. But in fact, it didn't. It continued to grow. Why? Why is that possible? You see, the model assumes that structurally the EP ratio remains the same, and the deviations from it is temporary. So the market should revert to the mean. But actually, there might be the case when there is a structural change in the market which results into a new level of P ratio and corresponding EP ratio, and the market is not supposed to return to previous levels. And if such a change happens, the model fails to account for it. It's supposed the market should return when in fact the market has reached a new reality, a new normal level. And this is probably the case why the contrarian model failed to work good during the second half of 20th century. And you see the average equity allocation after year 1950, according to the model, was only 80%, when in fact the second half of 20th century was mostly a good time for equity investors. Then the next conclusion is the difficulty of getting the timing right. The contrarian models, typically provide high accuracy only with the benefit of hindsight. So you know the past. From this point of time, you know what happened before. But when you try to use the same logic in a forward-looking way, the contrarian indicators give you only a coarse signals, not very accurate signals, and they often recommend buyer or selling too early or too late, but mostly too early in a cycle. And as Antti Ilmanen said, early means wrong. And there is another phenomenon which called headwinds from short-term momentum. What does it mean? The return shows some persistence or inertia over short terms, like trending behaviors in periods up to 1 year, basically several months. And contrarian indicators often give you signals to enter or exit stocks too early, which means the model says you should exit the market because it's overpriced. The assets are expensive according to the model, but the market continues to grow on inertia, on this trend, for extra couple of months. Or vice versa. The model says assets are cheap, go buy them. You bought them, they continue to decline in price. Why? Because the market shows the downward trend. It continues for 3 months, for example. But your psychologist says you made a wrong choice. And you exit those assets right at this time when they continue to rebound, they continue to increase. So basically, acting too early is bad, and the contrarian signals tend to give you this too early way of signaling. And the momentum momentum supports the return persistence, which basically contradicts to those signals. And if you consider contrarian signals over periods 2 or 3 years, they become quite accurate. But you cannot make decisions based on such a long time frame. You need to make decisions here and now, or within a very short period of time, within weeks or a few months, not within 2 or 3 years. And basically on short time horizons, contrarian signals are quite bad. And what else? Anti-Ilmanen says he has quite an important conclusion that if we consider contrarian indicators, contrarian signals, and momentum signals, and you were to choose one type of signal, you should choose momentum signal, because momentum signal appears to be right more often than contrarian signal. And there are a comprehensive set of research that he cites here in this book, that risk-adjusted return on trend-following portfolio is higher than on contrarian portfolio. But why this is not popular among the institutional investors? Because there is a poor cultural fit between momentum signals and their organizational culture. Contrarian approach is based on so-called scientific knowledge. There's rational expectations theory, there's mean reversion paradigm, and you expect the value to revert to intrinsic value, and thus you expect mean reversion. But the momentum signals, they don't have scientific ground, scientific justification, and therefore it's like rule of thumb, it's empirical, and people are afraid they could not be sustainable, those momentum signals. And they can be arbitraged away. And those are possible explanations why the momentum signals are not popular among the institutions. And the institutions tend to use contrarian strategies. But in fact, contrarian strategies, as we have seen here, they do not work. They do not work well. So basically, momentum strategies should perform better than contrarian. So basically, that's our conclusions that Anti-Ilmanen get and made, and I think they're quite important and quite essential. And they suggest how to build contrarian strategy, which indicators you could use. And also that you should not expect superior returns from contrarian strategies because of several phenomena that were considered today in our stream. So I thank you for attention, and as there are no questions, so I'll probably stop here. Stay on this channel. We will continue to consider interesting cases, interesting chapters from this book, and other cases, other assets. So stay tuned and see you next time. Goodbye.